Level AI-powered TCO capital markets AI model, where institutional level metrics help unlock AI-powered stock analysis for better decisions, real-time technical and fundamental analysis on every U.S. stock, seamless portfolio integration, easily add and track your stocks, data-backed insights sourced from the Securities Exchange Commission, Bloomberg, Yahoo, and more. Subscribe now for exclusive access. Real-time technical and fundamental analysis you can trust. Our institutional level analytics combine real-time technical charting with deep fundamental research. Our custom metrics empower you to make smarter decisions on any U.S. stock. For example, the Nasdaq's Apple up 2.45%, RSI 65.4, MACD bullish, support 175.50, risk level moderate. What does all that mean? AI-powered agents provide deep analysis, dynamic, real-time analysis powered by AI agents. We offer fundamental research, real data from the SEC, Bloomberg, Yahoo, and more. This is the Get Started button. This is the Sign In button. Let's get started. This is the sign-in page where you'll create your own account to join the TCO Capital for Institutional Grade Market Insights Club. TCO Capital Markets AI Model Overview has an analyst perspective embedded in the AI model. As we explore TCO Capital Markets AI model, it's important to understand how it differentiates itself from other models in the marketplace. Our model integrates both quantitative analysis and fundamental analysis, making it versatile for various types of investors. The model leverages advanced analytics to generate insights and investment recommendations, which are based on an extensive array of data sources. A fundamental investor may appreciate the model's ability to assess value from a historical and current perspective, leveraging traditional metrics such as price-to-earnings ratio. From this perspective, the confidence in the model's predictions becomes higher, particularly when viewed through a long-term lens. However, one of the common questions we receive is how the model ensures its predictions are reliable and how investors can be certain that it isn't manufacturing results. This is a valid concern, and the answer lies in the underlying data analytics and transparency within the platform. The model's reliability is grounded in data integrity, allowing us to confidently say that predictions are based on robust quantitative and qualitative analysis, not arbitrary assumptions. In response to questions like, how can an investor know if the system is accurate, we typically point to the model's historical accuracy and real-time predictive capabilities. For example, with metrics like liquidity ratings, the model can quickly evaluate whether a stock is in a strong or weak liquidity position, a key factor for many investors when assessing potential risk. A simplified way to think about some of the key metrics might be comparing a stock's beta. If it is above 1, the stock is more volatile than the market. If it is below 1, the stock is less volatile. This was created by Value Line. Similarly, the Sharpe ratio, created by Nobel Prize winner Bill Sharpe, studying under his PhD professor Harry Markowitz. If the Sharpe ratio is above 1, it is considered good, indicating the investment has provided returns above the risk-free rate per unit of risk. We also take into account the potential for discrepancies, such as concerns around financial reporting accuracy. For instance, cooking the books, which could still cause a stock price to rise despite underlying issues. While this scenario may seem plausible, the model considers such factors and applies safeguards against data manipulation through real-time monitoring of financial statements and other key indicators. Warren Buffett is a huge believer in annual statements. In terms of valuation models, the platform incorporates detailed tools such as discounted cash flow analysis, DCF. This allows for the assessment of a stock's intrinsic value based on projected future cash flows. A key component for investors focused on long-term fundamental analysis. The ability to distill complex financials into a clear, understandable format is one of the features that makes the TCO Capital Markets AI model appealing to users, particularly those who need a quick, actionable insights. Our model is we've destroyed, disrupted, and utterly ended the spreadsheet. While the model's simplicity and clarity are strengths, we also provide advanced options for more experienced users who wish to dive deeper into specific analytics, including financial risk identification and performance forecasting. This balance between simplicity and sophistication ensures that investors, regardless of their experience level, can gain insights that align with their specific needs. For instance, a hedge fund manager may see our tools very valuable, but a retail investor or a mom and pop investor would also find them extremely valuable. For example, a seasoned investor may want to explore value and technical investing styles simultaneously. TCO Capital Markets AI model facilitates such analysis by incorporating diverse disciplines, including value investing, growth investing, and technical analysis. Furthermore, it is possible to create a correlation matrix to assess how different strategies influence one another. While such analyses are advanced, they are certainly within reach for users who wish to take a more analytical approach. An interesting case could be a scenario like that of Cleveland Cliffs, a steel company. One of the company's investors may have a strong belief in its future growth due to anticipated political changes. However, the stock has been underperforming, down 50% despite this belief. In situations like this, the model can provide a data-driven answer, whether the stock is a buy or sell, based on both historical performance and future projections. Ultimately, investors use TCO Capital Markets AI model, want actionable insights that inform their buy and sell decisions. So whether you are looking to build a diversified portfolio or fine-tune an existing one, the platform comprehensive analytics and tools make it easier to make informed decisions. Lastly, as a member of this platform for the past year, I can confidently say that it has been extremely useful in tracking market movements and making data-backed decisions. The combination of robust analytical tools, real-time data, and clear recommendations is something I believe will be of immense value to both a seasoned hedge fund manager and a novice mom-and-pop investor. Everyone needs growth because we have inflation and depreciation of monetary assets. I look forward to discussing further how TCO Capital Markets AI model can enhance your investment strategy. Now let's move on with the fundamental link, part 2 in a series of 3, demonstrating how to use TCO Capital Markets AI model. Let's sign in. All right. Remember, your email address is your username. Okay, we're logged into the dashboard. Now we're going to discuss part 2. We've already discussed the dashboard. We're going to discuss fundamental. So let's look at a company that we all love. NVIDIA. Let's analyze it. Okay, now the stock analysis tool here for NVIDIA shows key metrics as the first level here. Current price $115, up 6.4%. Risk level moderate. Overall score 76.0. Okay, NVIDIA fundamentals. Now the question is, the risk level. What does this mean? The stock carries a moderate risk. This means that while it has a lot of good qualities, there are also factors that can make this price go up or down quickly, so it's not completely a safe bet. The overall score, the company gets a score of 76 out of 100, which is pretty good overall, but it shows there's room for improvement. NVIDIA demonstrates strong financial health with high profitability, excellent liquidity, and low financial leverage. The discount cash flow analysis and analyst ratings suggest significant upside potential. However, a high price-to-earnings ratio and market volatility indicate potential overvaluation, warranting moderate risk assessment. The stock's sensitivity to AI trade fluctuations and broader market corrections warrant caution. So here's how we would go on to define key findings. Okay, there are a few things here in key findings. Let's go through each one. High profitability metrics. NVIDIA is very good at making money. For example, its gross margin is 74.99%, meaning it keeps a lot of money it makes from sales. It also has an impressive 91.87% return on equity, showing it's making good use of the money its investors put in. Strong liquidity position. The company has a current ratio of 4.44, which is excellent. This means NVIDIA has plenty of cash or things that can be quickly turned into cash to cover its short-term bills. Low debt. NVIDIA has very little debt compared to its value. This is shown by its debt-to-equity ratio, 0.313 or 13%, which means it's not overly reliant on borrowing. 4. Valuation. The company's stock valuation price might be too high right now. The P/E ratio of 36.99 is a little high, which can mean the stock is overpriced considering how much profit the company is making. Growth potential. There is a 55.2% potential upside according to a financial model, which suggests that the stock could increase in value quite a bit if things go well. Stock volatility. The stock is affected by changes in the AI industry and the generated market, meaning it could go up or down a lot based on trends in technology and the economy. Let's go down further here. Okay. Analyst ratings. Expert analysts generally recommend buying the stock with a strong buy rating. They think the stock price could go up by more than 50%. Some analysts suggest NVIDIA has a strong competitive position with limited competition in the next 2 years. Okay. Now let's look at the risk level. The risk is moderate, meaning while the company looks solid in many areas, it's still vulnerable to big changes in the market, especially with AI-related investments. So even though it's a good company, its stock price could be unpredictable. Now let's look at financial metrics. Profitability. Profitability, excellent, with high gross margins and returns on investment. But what about operating margins? Operating margins is the money you make after you pay all your bills. We'll look at that later. Liquidity. Liquidity, great at handling short-term financial needs. Their current ratio is 4.44. Their quick ratio is 3.67. Efficiency. Asset turnover 1.17, inventory turnover 3.24. It could go up a lot because some caution is needed because of market savings, market swings, sorry. In short, Nvidia is a strong company with a lot of potential for growth. However, its stock might be a bit overpriced right now, and it's sensitive to changes in technology trends like artificial intelligence. So there is a moderate risk if you're thinking of investing. We have market data here, and this is just basic trading information you can get from any source on the internet. These are the price metrics, which whenever you look at the price of a stock, you'll get the high, the low, the 52-week high and the 52-week low, which is the one which basically is 1 year, and then the valuation, which is the price to earnings ratio, the earnings per share of $2.94, and then the rating, which is a buy. There's also an in-depth analysis that comes with it, and this is more thorough and explains some things that maybe a high-level manager may be more interested in. But sometimes the regular investor is interested in it. And what it does basically is it pulls together everything in our model, in our website, and does a great explanation of it. So as you see, there is a fundamental page with lots of good information and a holistic analysis, as we used NVIDIA for an example. Good luck out there. Part 3 coming soon. We'll discuss portfolio.